Hi guys, how are you? Mine this one titanium. Welcome back. Real macroeconomics and investing. Patreon.com/real macro. Come on down and subscribe. Patreon.com/real macro. All right, so we're trying to understand how macroeconomics works. Explaining it by building an economy from scratch. Trying to make it as simple as possible for everybody to understand how I view the economy. In this video, we're going to talk a little bit about taxes. We're going to talk about bonds, and we're also going to talk about imports and exports. All right. So, why does the government tax? Well, those of you who wish to live off the state need to remember that the state lives off of you, right? That's important. Why? Because it drives home the point that it's only the productive economy, you, right? Going out, working hard, being efficient, and um, being innovative that creates value for a currency. Okay, the fact that the government can create a digit doesn't mean anything. Without you, okay, there can never be value for a dollar, and that's why I say no government can create value for a currency. Now that doesn't mean that the government cannot help, right? Of course it can help, and the point of government is to fund large projects with unknown risks. That's the point of it, right? Typically, can do it through just taxation, but on some occasions, it requires the deficit spend, right? It's an investment. That's a good kind of spending. Um, buying junk bonds, private sector junk bonds, is not a good investment. Okay, that's bad deficits. And the reason they're bad is because it bypasses the productive economy and gives money to the top 5%, backstopping their risk. That's all I'm going to say about that. All right, so taxes. Well, what is taxes? Two functions, right? Wealth redistribution, and those dollars are spent right back into the economy in an ecosystem feedback loop. Now, an MMTer would tell you, oh, no, no, taxes are a drain in the economy. Well, they cannot be a drain in the economy because those dollars are simultaneously spent right back into the economy. Okay, so it cannot be a drain. It, it can be a drain if you're paying off a debt, or you know, um, paying off a bond, which we'll talk about here in a minute, but it has not been a quote unquote drain on the economy for a very, very long time. If you're spending it as fast as you're accumulating it, well, the net effect is not a drain. All right. So that's taxation. All right. Wealth redistribution, and think of it like a fuel pump to keep positive pressure back into the productive economy. Um, that's again if it's spent correctly. Now, when there's a need to spend more than what we tax, we issue a bond. This is what is called printing of money, right? We're printing money. You're not printing money, you're printing bonds, okay? That's what a deficit is. It's an expansion of the bonds. What is a bond? A bond is a dollar with a coupon. That's it, right? It's going to pay you an interest rate, 5%, whatever, on $100. That's what a bond is, okay? And the higher the bond, um, after its initiation, let's say it's $100 for 5% per year, whatever, okay? If there's a demand for it and it goes for $101, well, now you're going to get 4% interest rate, okay? And then if it's 102, then you're going to get 3% interest rate. So the higher the bond, the lower the interest rate. All right? That's the way that works. So we are at 0% interest rate. 0% interest rate. So that means the bond is appreciating. Now the question you might have is, well, why is anybody buying a bond if there's 0% interest? Well, because they are making money off the bond appreciation in price. Okay? The bond now is behaving like a stock. So people buy it because they believe the bond will be worth more and more and more. The problem with that is that eventually, uh, the law of diminishing returns means somebody's going to start to sell at some point. I don't know where that point is. Nobody does, but at some point people start to sell, and you know uh, that that's a whole can of worms that I'm not going to get into. So, how does the government deficit spend? It issues a bond. It takes money from savers, okay, money from savers, and pumps it back into the productive economy. Just like taxation pumps it right back into the productive economy. Both behave as jet pumps in a pool. And probably I shouldn't have used that analogy because it's an MMT analogy, but anyway, it creates a positive flow into the productive economy. Okay, so it takes idle savings. Okay, deficits take idle savings and pumps them back into the productive economy. And then after it pumps them in, the one is going to go back to taxation, the other one is going to go to household. Okay, and now the government is now funding the income for households. And then that income is dissaved and it becomes profit savings to the top 5%. And then those dollars go back into asset prices. Okay. And the bonds, they're going to get repurchased on future deficits. And that's why it's so important that you understand that deficits, okay, for those who believe the demand side is good, okay, well, yeah, it sounds good, but if you're going to take the savings and pump them back into the uh, productive economy and then the household saves it, it becomes profit savings, it goes right back to the, to the same person, right? To the same top 5%, the net savers, okay? The vast majority of savings is in the top 5%. Now, think about this, that while the vast majority of savings end up with the savers, okay, the vast majority ends up with the savers, the liabilities are shared among everybody. Okay, the liability is shared by everyone in the economy. But the beneficiary of those savings are with the top 5%. And the liabilities of those deficits, of those bond issuance, are for everybody. The difference is the net savers, they can always sell their bonds and go invest it elsewhere externally. So, you know, this becomes problematic. I'm not going to get too much into this, but something to think about for future videos. So again, debt, bond issuance, okay, takes money, idle savings from savers, goes into the productive economy. It funds household income, okay. It goes through the profit mechanism, becomes savings, and then those savings are invested in stocks, bonds, commodities, real estate, whatever. Okay, remember that. The beneficiary will always be of debts is always going to be with the savers, right? The debt is going to be with the savers, and the liabilities is going to be for everybody, except these people can go internationally. I hope that makes sense. Anyway, so um, savings are pumped back into the economy. The taxation goes back into the economy. So why do we need dollars always to be pumped into the economy? Well, because savings is a drain. Savings are a drain in the economy. So it needs to be replenished. And that's why I say ideally what you want is you want those profit savings, you want household to be funded by investment, not deficits. You want it to be funded ideally by investment, and then it goes back into uh, profit savings to the savers, then they reinvest it. back into the productive economy. Okay, not all of it, because you still need the commodities and real estate and stocks and bonds and so forth, but ideally you want a good portion of it to come back into the productive economy to fund household. So now let's talk about imports and exports. So what if the household just saves and purchases imports? Well, that exports dollars to the rest of the world, right? It goes externally. Now, some of those dollars make make their way back into the bond purchases, okay, and that's a whole nother video about that. And some do make it into stocks and bonds and commodities, okay, but those dollars are now um, uh, owned by foreign entities. Imports are also a drain of dollars from the productive economy because it outsources jobs to the rest of the world. Okay, but as uh, and I really don't want to get into this too much, but imports for a nation like the United States, with 5% of the global population, 25% of global GDP, our economy is so vast, so big, that we can still reach maximum employment of 3.4% and still be able to create jobs for people externally because we consume so much. Okay, um, that that is a special case. If you are, on the other hand, somebody like Turkey that doesn't have such a big economy, but you are printing, okay, you're borrowing, and you're importing, well, that's problematic because you can't do that forever. And what ends up happening is you are draining the productive economy. The productive economy suffers, the money supply increases, and this is the pure definition of hyperinflation. And that's why you're seeing the Turkish lira fall and fall and fall for about a decade now. So remember, you cannot print, borrow, and import. Doesn't work. I don't want to lead you to believe um, that necessarily Turkey is publicly borrowing, okay, but they are doing a lot of it privately, okay. Remember, all money is money, and when you are borrowing and you're printing and borrowing and importing, eventually you're going to end up somewhere where you don't want to be because there's too many liras in the world, not enough demand for those liras. The economy is collapsing and shrinking while the money supply is increasing. And what does the government want to do? Well, print more, create more bonds. Well, there's not enough demand for those bonds to begin with, and now you're going to issue even more bonds. You see what I'm saying? And then um, you end up in a hyperinflation situation. And that's what's happening right now in Turkey. Has it reached those extreme levels like Argentina and Venezuela? Not yet, but they're heading in that direction. So we'll talk more about this in future videos. But again, just remember that imports drain the economy of dollars or liras or whatever, and savings also drain the economy of the productive economy of dollars. We have taxation that is pumped back into the productive economy. We have idle savings that are being pumped back into the economy that make their way back into savers, and there's an increase in bonds. And so long as there's demand for those bonds, everything is fine. But once the demand is not there anymore, that can create havoc, uh, catastrophic chaos inside of an economy, which we'll talk about in future videos. So that's it for now. This video went on a little bit longer than I wanted to, but we introduced 3 new things. Don't forget, come down to patreon.com/realmacro, and we can talk more about how this affects your investments. All right, that's it. Thank you very much. I'll talk to you guys soon. Take care. Bye-bye.